I would like to talk about not the CFD as an obstacle and something very strange which nobody actually knows what it's going to be, but actually about what will it bring. Just as a reminder, as some people already told us before, 10 years ago we were at the exact same point when rock started, and everybody thinks they're great now. I hope that maybe even within 3 or 4 months you'll have the same attitude towards CFDs, because that means that I did my job correctly. Just to explain to you who is Neas Energy, because I would say that if 10% of the people in the room know who Neas Energy is, I would be very happy, but actually I think the other 90% would like to know who we are. We provide PPAs. We do not own assets, we do not have the intention to own assets, because we do not like conflicts of interest. So we have actually 6,000 megawatts of installed effect, but yes, 4,500 of those are renewables. The rest is CFD assets, of which the largest one is the city of Copenhagen, where we manage their complete CHP plant, so that's about a 330 meg plant. We manage about 2/3 of all onshore wind in Denmark. As a reminder, in Denmark about 35% of the power is produced by wind. In the UK we are currently stuck at 12 or so. So yeah, if the wind blows and it's a Sunday afternoon, we provide the whole country with power. In Germany we've started 3 years ago and we are managing there about 1,700 megawatts now. Sweden we have moved into in 2012, we are managing about 500 megawatts there. And in the UK we started February last year. I actually moved from Denmark over in January, and the first thing that I did was literally unpacking the boxes with my laptop and my screen, and that is how we started. I can now say that we're now managing 250 megawatts of assets. We have strong ties with a lot of very large developers, and we actually expect that we would double before the end of the year, quite easily. More than 200 megawatts of this is large-scale solar. We have been working together with developers to connect 17 sites only in March. So we are able to handle quick growth, especially with having the background of managing almost 6 gigs of installed capacity. Before I can talk about CFD, I would like to start about what is actually going on in the market today, because we've talked about ROCs and we've talked about grey power, and things have changed in the last 6 months, and not for a better way. If we would go back to September 2013, this is what the power market looked like. So at that point in time, summer 13 was basic, or sorry, winter 13 was trading at around 54. Summer 14 was trading around 49, 50-ish, and you could see that the winter and the summers were going up by 2 or 3% every year. And if you actually take 5 years together, then you could say, okay, in 5 years, the power price for summer would be about 11% higher. The power price for winter should be about 13, 14% higher. There were reasons for that. There was a decline in the supply and demand gap, as everybody is telling you, the lights will go out, and the lights will not go out. We'll just have to pay more for the power. We had a carbon tax, which is growing year on year, and because the carbon tax is growing, and most of the power is still created by fossil fuels, power prices will go up together with the carbon tax. And there's an inherent risk for forward pricings, because if you're purchasing power for 2019, that means that you have to guarantee as well that there's somebody who's going to deliver that power. So for those 5 years, the assets have to be also there. And in September 13, this looked pretty good. And if you were investing in ROCs, you said, oh, well, for my ground power, I'm going to go up with something RPI-like increase. And it's quite nice. Well, things changed. The most fundamental change is actually, yes, we had a mild winter, but we cannot underestimate how large the impact is of the carbon price floor freezing. That means that there is no fundamental anymore in the market which should guide the power price upwards after 2016-17. To reiterate that again, there is nothing which should let power prices increase after 2017. Because there's also other things. We get more and more renewables in the system, and more renewables means more free power. At least the market can pay up to zero for that price, and maybe even negative prices. Because the generator says, if I get, let's say, 1.4 ROCs, which is about 60 pounds, I am going to produce power if the power price is even minus 55, because I get 60 from one side, and I don't care if I pay 55 on the other side, because those 5 pounds I would like to get. That can happen. And we are not seeing that today. We will probably not see that next year. But over the term of a ROC accreditation, which is until the mid-30s by now, there's a quite good chance that we will see that. And of course, what has happened is there is a huge uncertainty. Even if the rumor about a ROC degradation was only a rumor and nothing will change, that uncertainty is now priced in everybody who will offer you a PPA, everybody who will offer you debt, and every investor will think twice before believing you that you will achieve 1.3 ROCs next summer. Now, apart from that, we had a different change in the market, and that is because we had a very, very mild winter. What I plotted here is the actual market price of summer 14 of the last 2 years, but you can see a very sharp decline since the 1st of January 2014. Basically, until the 1st of January 2014, everybody thought there's a 50-50% chance that we have a cold winter and we're going to use a lot of gas, and that will basically decrease our gas reserves, and therefore the power price for the summer has to be filled up with new gas. And everybody waited that that we would get a cold winter, and they waited longer. And you can see that slowly but surely, everybody started to realize there's no cold winter. Uh-oh, we've got so much gas left. We have to dump the prices because otherwise nobody is going to buy my power. And that little dip there between 1st of January 14 and where it actually ended has the same value as 0.2 ROCs. So 2.2 ROCs. Everybody is rushing in to get 0.2 ROCs more by the 31st of March. Whereas this is happening in the background as well. So you're not only, if you would have commissioned by the middle of April, not only have you lost 0.2 ROCs, you would have lost the equivalent because the power markets have dropped. And that this is not only happening for the coming summer, you can also see with the winter prices. Because there is too much gas in the summer, that means that we don't have that, and we have long-term contracts that there will be gas coming in the summer. That means that we need less gas for the next winter as well. So that price goes down as well. And that is how it cascades on from season to season to season to season. And the little spike that you see where we just go again above 48, and that you also see on the 2nd of March there, that's Crimea. So we had one day where everybody thought, uh-oh, the Russians are going to invade. But the next day we saw, we don't see so much tanks, the gas is still flowing. So if people think, oh yes, the Russians are going to shut down the gas, that's all the impact that this whole mess in eastern Ukraine had. So where are we now? Now we are seeing the blue line. As I said, there is no fundamental driver that the power price should go up after 16-17. That is a completely different view from where we were only 7 months ago. So people who are assuming that the power price will rise with RPI, I would say check your Poirot curves. And as an example, I'm not saying that this will happen tomorrow, this might happen in about 10 years, but in Germany you have a lot of solar and wind already installed. Because of that, you see those dips. The gray line is the base price for the 16th of June last year. Base for that day was negative because it's under zero. Actually, there's 2 hours in which the price went to minus 100. And the feed-in tariff is 100. So people are exactly producing until negative the support. That's what we will see at some point for everybody who's managing a rock asset, sorry. Now, we can just actually all forget that. We can just accept that having a rock asset might not be the most stable option. And especially, as Abid stated, we are going to professionalize. We want to have securitization, institutionalization, and long-term, slightly lower yields. We do not want to see these risks. So how can we get away from them? These are the administrative strike prices as they are set in law now. And what you can see here is that you get, if you're building a new solar site in 2015-16, so next summer, you will get £120 as a maximum. I'm going to talk about auctioning in a second, but this is the absolute maximum that you can achieve. It took me 3 days to actually, once this came out, to actually realize that there's a little two words in between brackets at the top, and that's, it's 2012 prices. Sorry. So it's £120 in 2012 money. So it's actually 129 or something like that. So I did a little bit of a calculation. So what does it actually mean? If you're building something and you're building something at 120 price next summer, in real world money, that's actually £129. So you're actually a little bit better off than what the numbers state in the first point. And yes, you're going down by £5 in 2012 money, but in real term, you actually only go down by slightly less than £3. That's the difference between 129 and 126 there on the bold numbers. But how do you get one of those? We kind of know how it will be allocated. We know most of the details, and yes, absolutely, we have to wait until July until you get parliamentary approval and everything will be set in stone and we know exactly how the auctions will go, but we are ready to have a commercial discussion about this now. We actually also have to, because by October you have to apply for this. And to be able to apply for it, you have to do your homework. After you applied in November, you know if you are actually allowed to participate. Then you can put in a sealed bid, and I'm going to come to sealed bids in a second, which means that by the 19th of December, you actually know if you're going to get anything or not on the CFD, and then by April, you can get your first payment. The offtake of last resort is a great thing, but government, of course, made sure that you're not going to get it in the first year, so you need your PPA, especially for the first year. And, oh yeah, whatever happens by April 17, you have to go through this route. Now, from a PPA point of view, what are the big differences? The hugely big one, and the most important one, and especially for Abid, it's going to be you no longer have an exposure to the power market. And that's what makes the whole sector ready for institutional investment. The reason for that is because you no longer get a fixed amount of top-up, which means that you're exposed to the power price, but the government is going to adjust your subsidy in such a way that whatever the market does, you get a fixed amount on top, or they're going to ask you back for that if the market goes very high. But you'll know what you're going to get for the next 15 years with CPI inflation, and you simply are in a vacuum when it comes to what the power market does. You're going to lose 5 years of your support for that. And whereas today, if you're building a 4 megawatt site, you can choose between small scale fit and rock. In the future, you can only get a CFD if you cannot get a small scale fit. So 4 megawatt sites will not get this. They have to go to small scale fit. From 5 megawatt upwards, you can't get small scale fit, so therefore you can get the CFD. If we look at protection for investors, again, the big thing here is under the RO, an investor and a debt financier, and I think Deepak is still in the room, today you have to get PCGs, letters of credit, gold bars, whatever, something to keep your debt financier happy. In the future, I hope that a lot of the debt providers can be assured by the fact that there's a backstop PPA provider. that makes the PPA a lot cheaper because I, as a PPA provider, do not have to put down collateral for your debt lender. Do you still have upside opportunities? Well, on the renewable obligation, the upside opportunity is huge. If the power market goes up, you can gain up to 100% of that, depending on how you do your PPA negotiation. Under the CFD, too bad, because the government is giving you security, but for that you have to give up all your upside. On the other hand, you could look at making, let's say, short-term CFD contracts where there might be some upside opportunities, but this is getting a bit complex, and to cover all of that will not fit in this time slot, but I'm going to be around here so we can talk about that. And of course, we should not forget, the CFD is replacing only the ROCs. You're still going to get your legs, you're still going to get your embedded benefits, and you should also get rewarded for that. I did a little bit of modeling. That's what the PPA market looks like today. So if you are building something on, let's say, May 15, you get 1.3 ROCs. I just assume that the Daily Mail is just wrong. And then you get this blue amount of money, which is basically an income of ROCs. I assume that you're getting 100% of the buyout and nothing of the recycle, something that you can achieve in current PPAs. If you want to know where, you can give me a call afterwards. You can secure the income for your power for up to 5 years. So that's the red part. We offer 5-year fixed prices for power. And then you can assume that it should not get worse than what the government calls the high green scenario. Now, the high green scenario assumes that we are actually going to build 10 gigawatts of installed effective green stuff. Since we had the early FIT CFD confirmation, so that I think it was 4.5 gigawatts of offshore wind is going to be built, this is no longer actually one of the possibilities. This is actually going to be what will happen, because once all those offshore wind is going to come online, they will produce, and that will drive down the power price. But as you can see, if you get a strike price, and I assume that we're going to do a sealed bid, and I assume that you're going to be in competition, and I assume that people are saying, well, I'm also happy with 118, and let's assume that you're actually going to get it then. You get the orange line, which year on year, in the years in which you get support, every single year you would get more, which is great. You do lose, however, the last 5 years of ROC protection. So the blue part for the last 5 years is gone. The green part is not gone, because once your CFD is gone, you still get the money for your power. If you look at it then from an investor point of view, every investor will tell you, yeah, it's nice that you have this curve about what green is and so on, but let's just forget that, because nobody is going to make sure that I, as an investor or a debt provider, am actually going to get it. So what I did is, the blue lines is the revenue that you get from your ROCs, plus the first 5 years of power, and the orange bars is the money that you would receive under the CFD. And I'm assuming that you're producing 10,000 megawatt hours every year. It could be 20, it could be 5, actually it doesn't matter, because both lines will scale up or down, because it's about money per megawatt hour. And you see something quite interesting. After 15 years, when your CFD ends, under the CFD, you would achieve an amazing 40%, 60% more if you look at it from the ROC part, under the CFD. Now, if I would be an institutional investor, I would say, I couldn't care less what the power market is doing, because I want to have that CFD money. And even if you take into account the last 5 years that you would get under the ROCs, you would not achieve that high level of securitized cash flow. Yes, you have a high chance that you will also get more money for the power after year 5. But an institutional investor really saying, I think that this will happen? I would doubt that. If I would be an institutional investor, I want certainty. I want that CFD. Now, how would a PPA then look? Because as Alan mentioned, a CFD is not a PPA. You still need somebody to take care of your power. We would say, well, today you can see people who are offering you, I think you mentioned 80% of brown power or 85% of brown power or something like that. Again, an institutional investor says, I got the CFD. I do not want to be exposed to the power market. Then we say, fine, okay, let's forget the power market. We're going to do a fixed fee in pounds. So whatever the power market does, you know, we're taking X pounds per megawatt hour to balancing, to make sure that we are selling the power at this market reference price. So you get from us the market reference price minus X pounds. You get from the government the difference between the market reference price and the strike price, which means net to you as an investor, you get the strike price that you have achieved minus our fixed fee. You just get it from two different sources, but that's a bit of accounting. That's not a risk. That's simply doing your Excel sheets in a correct manner. Now, what will happen is that the longer you want to have this fee fixed, the larger the fee will become, because we have to anticipate every possible scenario what the power market will do in the future. Because we are taking away from you the risk that the power market might go up a lot, or it might go down a lot, or you might have a lot of negative prices. But I think that we can handle that. I think with about close to 6 gigs, we should be able to handle that. The beauty of it is also that you're going to get your CFD money 28 days after the fact that you have produced. And you get our money also around about the same time. So rather than today having to wait for 4, 5, 6 months before you get the money back for your rocks, you just get everything in monthly arrears. Isn't that nice to be able to say to your investor, no matter what happens, my maximum counterparty risk is just 45 days? And as Alan mentioned, there is this backstop PPA. That backstop PPA is a transparent and open thing, and we are going to strive to copy as much as possible out of the backstop PPA and out into our own PPA, because that would make the whole contractual arrangements very, very easy. It's just a different discount that we apply rather than the backstop. So there should be clear and transparent contractual terms. And the financial arrangements should be relatively easy, because I only have to pay you for the power and the embedded benefits and the legs. The biggest part is just coming from the government. And if you need help in doing the administration for that, we could do that for you. So what do you have to do? In October, everybody who wants to have a CFD will have to compete with each other. And you have to compete on what you expect, what you will need in order to satisfy your investors. That means that at that point in time, you need to know, what is my cost for CapEx, what's my cost on OpEx, what's my cost for debt, if I want to introduce debt, and what is the cost for the PPA. Because if you know that, then you can, in-house, look at, okay, I now know what all my cost is, how much IRR do I want? And then we shouldn't think about the IRR that we're achieving today and that we're striving to achieve. We should think about an IRR that we are certain we can guarantee our investors for 15 years. So we're talking about bond-like structures. The IRR will be lower than on the ERO, but the risk will also be a lot less. Now, once you have the IRR and all the costs, you can then calculate back what should be my submitted sealed bid. And the beauty of that is, if there's somebody else who also does this calculation and their IRR is a little bit higher or their CapEx is a little bit higher, and they also get an accepted bid, you will get the same strike price as the most expensive one gets. So again, if I would put in a bid at I don't know, 105, Abis puts in a bid at 110, and John is putting in a bid at 115, but the government says I only have enough to pay me and Abis. That means that he's getting 110, and I also get 110. So there's huge upside value there, without having actually risk, because I know that I would have done it also for 105. If the government is only prepared to give me 104, I wouldn't have been able to meet my IRR. Then I wouldn't have built it in the first place anyways on the CFD. And I think that's it. And I think that there's going to be a lot of people who would like to talk about this.